This is the Retirement Plan Playbook. I am Brent Pasqua, and I'm here with Matthew Thiel and Joshua Wonderswike. And we are podcasting quarantine style from our homes today. Josh and I are podcasting from our homes in Rancho Cucamonga, and Matthew is in Los Angeles. And this is episode 22. And today we're going to talk about the CARE Act and how the CARE Act affects individuals. And for anyone who doesn't know, the CARES Act stands for the Coronavirus Aid, Relief, and Economic Security Act. It is a relief package they created for individuals to really help them get through this difficult time financially that many people are going through. I guess really the first question I have, Josh, for this CARES Act is who is actually going to be receiving this money?
That's a great question. I think that's the most popular question I've been getting too, is who's getting the cash payments. And really 90% of taxpayers will be receiving a one-time cash payment. And depending on if your tax return you filed individual, that one-time cash payment could be as high as $1,200. And if you're married filing jointly, it could be as high as $2,400. And then also, there's also some other provisions in there that if you have children under the age of 17, you'll get an additional $500 per child. And this is in the form of a tax rebate, but it's essentially free money if you qualify.
Yeah, who doesn't love free money? One frequently asked question that I've got a lot is if you're just on Social Security, if you get a check. And from my understanding, from everything I've read, that's a yes. Is that what you guys have heard as well?
Yeah,
Yes.
I've heard that too. You're still gonna get a check, and it doesn't even matter if you filed a tax return for the seniors or retirees. You still potentially are gonna get a check as well.
So
What is the system?
Yeah.
what does it mean that it comes in the form of a rebate?
Well, really, the public can look at it if you do qualify. You're just going to get that actual cash payment into your bank account. But let me give a real life example. Let's say that you don't qualify because there is some income limitations, but you do lose your job this year and your income's going to allow you to qualify at the end of the year. Then that amount will be rebated to you in the form of a tax credit at the end of the year. So you will still receive the benefit of this stimulus. So that's the way they're structuring that cash payment, is in the form of a tax credit.
So
Disappointing.
Go ahead, sorry.
It's disappointing they did it this way. They should have just sent money to everybody. That would solve that issue you're talking about, Josh.
Yeah, I think that it is an issue because, as we've already talked about, someone who doesn't qualify, because their income was too high in 2018 or 2019 that's reported, and then lost their job, they can make the argument that they needed the money more, now than ever, or more than someone who actually received it. So I think it can be looked at as unfair for those people who don't qualify right now, but potentially will at the end of the year.
It doesn't to me seem like a lot of money that people are getting paid, especially if they lose their job and people have bills to pay and they have expenses. And is there a plan to have more money for individuals at this point, or is this basically it?
I haven't seen any plans floated to get more money to individuals. There's been a lot of plans floated to get more money to the small business owner side. Remember, if you are unemployed, you still are getting unemployment, and that's been expanded as well, which we'll talk about later in the show. So really the idea with giving people essentially free money like this is they want to get it in your pocket and get you spending. Maybe you'll buy a new MacBook, maybe you'll buy some AirPods, whatever it is, they want you stimulating the economy.
So who is not going to get this money?
So it's actually unfortunately phased out based on income. So if you are what we call married filing jointly, so you're married and you file with your spouse, if your AGI is under 150,000, then you get a rebate. If it's over, you actually get phased out. If you're a head of a household, it's 112,500. And if you're a single filer, it's 75,000, and that's your adjusted gross income. And if you haven't filed your 2019 return, it's based on your 2018 return. Again, very disappointing they did it this way with the phase outs. Josh, I don't remember off the top of my head, but let's use married filing jointly as the example. Do you remember? Isn't it like 199.93 or something like that people get phased out at, where they end up getting absolutely nothing?
Yeah, and there's some good calculators. I think you're right about that amount. And there's some calculators that you can put in your AGI, and it'll tell you how much you'll actually be receiving. I think it's the discount on the adjusted gross income over the restriction or the phase out level is $5 for every $100 that you go over. But again, just Google search stimulus paycheck calculator and put in your AGI, and you'll be able to pump out, your number if you are questioning whether your income level is under the phase out or not.
So what happens if somebody in 2018 was below these income levels and they get the stimulus, but this year they make, over these levels? Are they gonna have to pay it back in any capacity?
So to answer your question, no. And a strategy that, we've been reading about is if your income was lower or below that phase out threshold in 2018, and you expect your 2019 to be over the threshold, it might be beneficial for you to utilize that extended tax deadline and not file your 2019 taxes until you get your check. Because that 2019, when you file it, they're not going to take away your stimulus check if you've already received it.
So the thing that I keep wondering is if it's going based on a lot of people's 2018 tax returns, because most people haven't filed their 2019 returns with the extension, and people in 2018 had really good years. Husband and wife were working, they've had joint income, they were over these thresholds, and then by March of this year, they lost their job. They're hurting for money. What about those people?
They might be a part of that 10% we were talking about, unfortunately.
Yeah, that's what a lot of it is. The one thing that I will say is when you do look at the unemployment numbers, it does seem like a lot of people who are losing their jobs today are in the service-based industries. Maybe they're a waitress or a waiter, a busboy, a cook, a retail worker, and those are on the lower side of the pay scale. So all those people should be receiving this check in addition to their unemployment.
Okay, that provides a lot of clarity. So what changes regarding the emergency distributions from retirement accounts were part of this CARES Act, Josh?
So a couple of big changes with this disaster or crisis that the CARES Act actually implemented was you could take out from your retirement accounts without the penalty. So it's really big because there's a 10% penalty if you take out from your retirement accounts if you're not 59 and a half or older. And this amount is up to $100,000 that you can take out from your retirement accounts to help supplement, obviously, this hardship that we're going through. You must have a reason, though, to take it out. And to avoid that penalty, it must be diagnosed with COVID-19 or your spouse be diagnosed with COVID-19. Also, if you were furloughed, laid off, reduced hours, you were a business owner and you've had reduced hours. So the actual reasons are pretty, broad. So, if you were affected in any sort of way and needed to take out money from those retirement accounts without that penalty, most likely, if you were affected and seeing a loss of income, you'd qualify. Again, the amount is still taxable if you take it out, and it could be eligible to be repaid back into the accounts up to 3 years. It's kind of like a 60-day rollover rule, but it's a 3-year rollover rule. If you take it out, you have 3 years to actually pay that money back into the retirement account.
And at that point, you would recover the amount of taxes that you've paid into it.
Correct, because on that distribution, you are going to pay taxes on that distribution in the year that you do take it out.
I'm not sure if I like this that much. I mean, it's nice for people who are hurting, but I think that if you have been impacted by COVID-19 or you did lose your job in some way, try and avoid this one as much as possible. I think there's probably better options to get money. But like you said, Josh, I mean, this is still a taxable distribution. And in a way, you're stealing from your future to help yourself now when there are hopefully going to be other measures to help people who are significantly hurting financially right now.
Yeah, I have to agree with you. I think that, this is tread lightly when you're looking at taking out from your retirement accounts, not only the tax implications, but then you're also taking from the accounts that are invested and the market's down. So, you really have to be careful when you're looking at taking out from retirement accounts and sacrificing that future. Now, again, there are going to be people out there that absolutely have to, and we understand that. But again, just make sure you do the right research and making sure that you taking it out is going to actually help your situation and benefit you, because there are a lot of consequences to doing so.
Yeah, like if you're hurting financially, this is probably your last move. I mean, let's say you have a mortgage and you're planning on using this distribution to pay your mortgage. Call the mortgage company.
Yep.
Tell them you're not going to be able to make payments for 3 months until your job starts back up. Try and negotiate that way instead of, taking the quick, easy route, which is stealing from your future.
I agree.
So in this CARES Act, what changes or adjustments were made to employer plans?
Yeah, so I actually, we were kind of knocking the last one, obviously, but I like the employer plans changes a lot more. They increased the maximum loan you could take from $50,000 to $100,000. And the nice thing about a loan in a 401k is you're borrowing your own money. So you could repay it over time with your contributions, or when you go to retire, you just get that much less from a distribution. They also changed it so 100% of your vested balance may be used. I believe previously, Josh, wasn't there a calculation you had to do to see how much eligible?
It was 50,000 and then 50% of your vested balance.
Yeah.
So yeah, it was a 2-part calculation of how much you could actually loan from the 401k.
And then payments on the loan are delayed a year. So another nice feature there.
A great solution if you're looking to take money out, for the short term, instead of actually taking that distribution like we talked about in that last change.
Yeah, absolutely. I like this one. It's better than the IRA one. Again, last resort type deal though, right?
I agree. Yeah.
I know that there's another big change in this act. What happened to the required minimum distributions? I think this is impacting a lot of people who are retired or who had inherited IRA money. Tell us a little bit about this, Josh.
Yeah, so RMDs, a lot of changes with RMDs, it seems like, over the last year. But the RMD is your required minimum distribution that the IRS mandates you to take out from those retirement accounts. And for 2020, they're actually waiving or suspending the RMD. So if you haven't already taken out your RMD for 2020 or your required minimum distribution, you will not be forced to in this year. And what this will do is just help keep money in your retirement account, not having to force a sale and a distribution and paying taxes on that account now that account most likely has declined. So also first timers, so if you haven't taken your RMD yet and you were waiting till 2020 to take that RMD, from 2019, that's also suspended for those. So those people who fit into that gap, they're actually missing 2 RMDs, which is actually, pretty nice feature for them. With this change too, this does include stretch IRAs or inherited IRA RMDs. You get to suspend or waive this year's RMD if you haven't taken it already. And then that's also for the 5-year rule. So if you're, on a 5-year distribution schedule for the retirement RMD payout, this year will be ignored. So you'll have that extended to a 6-year distribution payout.
This is a great rule. I absolutely love this. I remember